Hello and welcome back to the Wall Street Petting Zoo. I'm Christopher C. Smith.
And I'm Robert Coburn.
And this week, Robert, we've got some coronavirus news. We've got some economic data. We've got some comments from the Federal Reserve. So let's go ahead and get into it.
The coronavirus got a lot harder to forecast this week. Monday, Tuesday, and Wednesday, the market rallied because it looked like coronavirus was slowing down quite a bit. By Wednesday, our model went from forecasting about 190,000 cases by the end of February to forecasting fewer than 80,000 cases. But then on Thursday, there was a huge spike in the number because China changed how it's counting cases. Up till now, we've only been counting cases that are confirmed with testing kits. Now we're also counting cases diagnosed with CT scans because apparently they're running out of testing kits. And I think I texted you about this on Thursday about how the numbers just suddenly spiked.
Yeah. And so the question that we have to answer is, was the slowdown early this week real, or was it just an illusion caused by the Chinese government having run out of testing kits? I've only got a couple of data points to work with, so I'm not really sure yet. But right now, it looks to me like the slowdown wasn't real. Meanwhile, the quarantine in China is getting even more draconian, with people not allowed to leave their houses. They've effectively put the Hubei province under military rule and said, don't leave your house unless you're going to the hospital to seek medical treatment. And this US CDC is also reporting that it's having some trouble enforcing the quarantine because we've discovered that the testing kits aren't 100% accurate. So people are getting cleared from quarantine when they shouldn't be cleared. So for right now, we are at all-time market highs, but unless the number of new cases flattens out a little over the weekend, we might see the market return to coronavirus panic next week, because right now the trend is looking like it's gone back onto an exponential growth curve for the number of coronavirus cases. Honestly, I think it's kind of silly for the market to be this high anyway, because even if coronavirus went away tomorrow, it's already done huge economic damage. But we'll see what happens with this. I'm not super confident about coronavirus and its economic impact going into next week.
Yeah, we also had a lot of economic commentary from the Federal Reserve this week, so let's dig into that a little. On Tuesday, Fed Chair Jerome Powell said the U.S. economy is in a very good place, and that he sees no reason the economic expansion can't continue indefinitely. He said he doesn't think the economy is headed for a recession, and coronavirus doesn't yet pose a quote-unquote material risk to the U.S. economy. But long-term, I believe there will be an impact to the U.S. economy due to how many companies rely on cheap China labor to produce their products.
Yeah, and on Wednesday, Powell actually kind of undercut his own comments because he said that low interest rates are now a fact of life, and the U.S. economy can no longer survive without them. We can basically never raise interest rates again. And with interest rates so low, he said the only option for stimulus during the next recession will be to aggressively print money, which is what economists call QE, or quantitative easing. And in fact, the Fed is already doing QE on a small scale to keep repo markets from going underwater, but it will have to do it on a much larger scale during their next recession. And he expressed some concern that basically the Fed doesn't have the tools to respond to the next recession because interest rates are so low. So we're in a bit of a catch-22. We can't raise interest rates without triggering a recession, but we also can't lower interest rates during the next recession very much because they're already so low.
And why can't we ever lower interest rates again? Well, for one thing, the U.S. federal budget deficit is now over $1 trillion. Cue Michael Myers. And expected to average $1.3 trillion over the next decade. Federal debt as a percentage of GDP is expected to double by 2050 to about 200% of GDP. So one reason we can't raise interest rates is because we'd end up spending a lot more of the federal budget just paying interest on the national credit cards.
Yeah, and those those forecasts assume that we don't go into another recession. So if we go into another recession, the situation is going to be even worse. And meantime, the latest presidential budget proposes a great deal new spending. So lots of problematic stuff happening at the federal level, and that's just federal debt. The private debt picture is even worse. Americans now have $1 trillion in credit card debt. According to numbers that came out this week from the New York Federal Reserve, which is a new record. And the percentage of people overdue on their credit card payments by 90 days or more just rose to its highest level in 8 years. So we've got rising default rates at the same time that we've got rising credit card debt. And also, according to numbers released this week, total household debt topped $14 trillion last quarter, which is also a new record. A lot of that was mortgage debt, which increased by over $400 billion, even as home equity decreased by $20 billion. So any increase of interest rates would make it that much harder for Americans to make payments on all of that debt. It would also slow the whole economy and put a lot of people out of work, causing a cascade of defaults and bankruptcies. So in other words, we live in a credit bubble now. We're in a credit economy with not very much assets to back up all of that debt. And any hike of interest rates could burst the bubble and bring it all crashing down.
But the American economy is in a quote-unquote very good place, though, you guys.
Yeah, depending what happens with this coronavirus thing, I actually think we're at real risk of seeing a recession this year. We still in the prediction markets have the forecasters pricing in about a 23% chance of recession in Trump's first term. So by November, they're expecting about a 1 in 4 chance of recession in the U.S. economy. There's not much sign of it yet, though. Jobless claims, retail sales, and industrial production this week all came in line with analyst expectations, about consistent with the previous month. We did see, we are still seeing a slowdown in industrial production. It's been slowing down at the rate of about 0.3% per month. But, not a huge slowdown in industrial production. And consumer sentiment is actually beating analyst expectations in February pretty significantly. So we probably won't start to see real ripples from coronavirus until next month when we get the economic data for February. Right now, the economic indicators still look pretty good, but we might start to see this impact hit the markets next month as those economic data came in. So let's talk stocks we watched this week. Robert, why don't you go ahead and get started?
So this week I was looking at Lyft, which ended the week down 20% despite a year-over-year 50% growth of revenue. The company is still burning through cash, and unlike Uber, which gave a timeline for when they can be profitable, Lyft did not provide that during their conference call. So that caused some concern for investors, and so that's why we saw the 20%, not 20%, but we did see the stock dip this week. Under Armour reported earnings, and part of their forecast was they predicted they will be taking a $60 million first quarter hit due to the coronavirus. This is the first company I've heard that, or the first company that actually reported a quantitative number of how much they will anticipate the coronavirus will impact them directly. So they also announced they may not be opening their new store in New York on Fifth Avenue, the famous Fifth Avenue that has all those fancy, really expensive stores that most of us probably don't shop at. The stock plunged 19% on this news. So really bad news for Under Armour this week. And then CVS, they posted strong earnings, and it appeared some investors were expecting more as the stock ended the week slightly lower than in Century Point, despite being up $3 per share in the middle of the week.
I had missed that news about Under Armour. That's interesting that they expect a $60 million hit. They're basically like an underwear, sportswear brand, not one that you would naturally expect to be impacted by coronavirus, although I don't know what their exposure to China markets is like. But that, to me, is a bellwether for what the rest of the economy may report once people start to sort of figure out what the impact is going to look like. I think we may see a lot more of that. So that's interesting. That's a little worrying. All right. The stocks that I watched were AbbVie, Curo Holdings Group, and PennyMac Financial. AbbVie ended the week up about 2%, though I actually got out midweek when it was up about 3%, and I could see it sort of slowing down and topping out. It appears to be in a downtrend now, so I won't buy back in until this stock finds some support somewhere. I expect that it will fall this coming week. Curo Holdings Group gained 8.5% this week, and I think that it may continue upward next week, so that one worked out really well for me. Remember, this is a stock that initiated its first ever dividend, meaning that it's moving toward trading at a higher multiple. So I think that one could continue to go up over the next year or so. PennyMac, however, came down this week by almost 10%. because it paid its dividend, and stocks often come down after a dividend because the market kind of prices that in. And also because a major institutional investor donated all of its shares to charity. So I'm still hanging on to my $40 March PennyMac calls because I still think this stock is a great value and I am expecting it to recover, but it didn't have a great week this week. What stocks are you watching next week, Robert?
This week, I'll be watching Jack in the Box, Vulcan Materials, and Hormel Foods. So Jack in the Box has always been one to shake up the fast food industry by constantly testing out new menu items. Not all of them are winners, and you can see that in the spikes in their stock price. Lately, they released tiny tacos. I mean, I tried them. I wasn't really impressed, but analysts are expecting them to boost Jack in the Box's numbers when they announce earnings on Wednesday. By the way, Wednesday is the first time they will webcast their quarterly earnings, and I wonder if Jack, who normally does all their commercials, will be announcing their earnings in a quirky video. So it'll be interesting to see if they do that on Wednesday. I doubt it, but it'll be interesting if they do.
That'd be fun.
Yeah. Vulcan Materials just announced that they will be increasing the dividend to all shareholders, with the CEO stating that we have increased the dividend to reflect the company's strong operational and financial performance and our confidence in delivering sustainable long-term value to our shareholders. So they announced this a week ahead of their earnings report. So that's a good sign that that it may be a good time to buy in, that good things are to come to Vulcan Materials, or at least that's what they may be giving the perception of that. They may be actually announcing really poor performance, and they just want to, cover their bases.
That does happen sometimes.
Yeah. And Hormel Foods, it's the last stock I'll be watching. It's expected to beat forecasted earnings, although revenue is expected to be flat year over year. The stock is at an all-time high, and if they miss earnings, it may represent a buying opportunity to purchase it at a weakness.
Yeah, so I am going to continue to watch Curo and PennyMac because I think both of those have the potential to go out this week. And I'm also watching One Main Holdings, which the ticker is OMF. This stock not only beat analyst expectations this week on its earnings report by quite a lot, but also declared a 5% special dividend in addition to increasing its regular dividend, which now stands at about 2.5%. And those go ex-dividend about a week and a half from now. So with about a 7.5% dividend payout coming up about the 25th, I think this stock could move up next week as dividend investors buy in order to harvest that dividend. This is also a pretty undervalued stock anyway, with solid earnings growth and a forward PE under 7. So pretty inexpensive stock on that one, and I think that could gain a lot this week. I've also bought cheap calls on Blucora and Viacom CBS ahead of their earnings reports this week. Both companies are pretty undervalued, and so they could get very large spikes in share price if their earnings beat analyst expectations. So one of the strategies that I've been using in options trading is find the companies that are reporting earnings that are really, really undervalued already, because those ones, when they do beat earnings, tend to get major gains. And so you can, more than triple your money on some of these earnings plays. And typically about 70% of companies do report a beat of analyst expectations, plus you have the potential for things like dividend raises. So, on average, companies are going to beat expectations more often than they're going to miss expectations. So I think that, playing earnings is a pretty good bet, and especially playing earnings on undervalued companies is a really good way to go. So that's what I'm doing this week, Robert. Anything else you want to say before we sign off here?
Yeah, actually, I'm still holding on to those Viacom stocks that I bought before the merger, or before we talked about it. I think it was like a couple weeks ago. So I'm very interested in seeing how Viacom, especially with the announcement of the new streaming service that they'll be releasing, I definitely want to see how that's going to pan out.
They also announced this week that they are getting into sports betting. They signed a deal to do sports betting. So they've got a lot of news coming out, but the stock has been a little bit halted. I'm not really sure why the stock hasn't reacted to all of the news, but I think that if the earnings report gives a green light, then we could see pretty significant upward movement on this stock as it sort of prices in all of that stuff. So, all right. Well, if you folks heard anything on this podcast that you found valuable, please give us a like, share, or comment on YouTube. You can, underneath the YouTube video, you can find links to our Facebook page and Twitter. We'd really appreciate if you follow us on Facebook and Twitter and share it with your friends. And also, we have a referral link to Webull, where you can go to Webull and deposit $100, and you get a free stock, we get a free stock. That helps support the podcast. Webull, by the way, now has options trading, and I saw the other day they have integration with TurboTax, so they're becoming a really legit platform. And I continue to find them much, much more user-friendly than Robinhood. I think that switching to Webull was one of the best things I did. So I highly recommend you go do that if you're looking for a good platform for commission-free trading. And thanks so much, guys, for listening, and we will see you back at the zoo next week.
See you.